So hello and good afternoon. I welcome you to today's special webinar, how to trade the market opening of the US markets here exclusively for JFD Brokers. My name is Jens Klatt and I'm the Global Head of Research and Education at JFD Brokers. And I have the pleasure to guide you through the next hour here around the US market opening. In fact, very interesting market opening since I myself are excited to see I'm myself excited to see how the US markets open after yesterday's Fed minutes. In fact, the minutes itself didn't seem to be that outstandingly exciting, or let's say deliver something we haven't heard before. But the market reaction after several minutes was quite obvious. In fact, yields spiked again. 10-year T-note yields moved above 2.9%, and yeah, we're short. Came short of reaching the level around 3% here, and equity markets just saw a quite significant pullback. So the S&P, just have a look here at the DAX first, which already shows here the reaction. Quite interesting also to see that the DAX, after an initial push lower here, which was kind of continuation of this move here yesterday. So around here you can see that's 8 p.m. German time, so 7 p.m. GMT, and the market moved strongly lower towards the region around the intraday lows, which could be found around 12,370 points. And then after a quite neutral opening, market headed aggressively lower, but reversed strongly to new intraday highs and can right now stabilize around this level. During the morning meeting, the German version of the morning meeting, I nevertheless said that I'm not really convinced here, to be honest. So in fact, nothing big changed for the DAX itself. So the DAX, you can see it here, stabilizing between 300, 12,280 and 12,300 points on the downside, respectively, below 12,530 points here. And within that range, we should consider the overall price action to be choppy. The test of this region, to me, didn't came with a surprise. Didn't came with a surprise that the market was capable of stabilizing here. What comes with the surprise is the quite strong reaction. But again, I don't buy it. I really don't buy it. And I'm really excited to see what will be delivered from US equity markets. Because again, now let's have a look here at the S&P. That was very, 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 very strong. And in my opinion, bearish what we've seen yesterday here. So after a quite strong start into the day and also a push higher here, around 7 p.m. GMT, the market then sharply reversed, and not just reversed, but in the high we were traded around 2,750, in fact 2,747 points here, and then pushed lower to 2,700 points, and not just pushed lower, but closed here at the daily lows when the spot market, when Wall Street closed. And that is, in fact, something which is not leaving a very positive feeling. So my personal opinion, even though I have to wait till we get to see an open range here, which has to form between 2:30 p.m. GMT. So we have to wait another 25 minutes, and that's the starting point of the trading range then. And the range will be defined around 3:15 p.m. GMT then. We have to wait if there will really be the breakout out of this range here on the downside. But all in all, I have to say I wouldn't be surprised to see a break on the downside. And this reaction yesterday also shows that I am very, very skeptical when it comes to breaks out of this range here then on the upside. So, or put it differently, we have a predefined setup, and I will share this with you right here. 1 second. So that's the definition of the open range. I can easily give you those 3 steps here with no big problem. And you can see that obviously we have to wait till 2:30, respectively, till 3:15, because between 230 and 315, you can then define the open range, the high and the low, and we get then identify the advantage, which we will do in our case here based on the 15-minute exponential moving average 10. And if we're trading above that, we're only trading the long side. If we're trading below that, we're only trading the short side. But, and this is the thing, what I just told you here, and based on this price action from yesterday, I have to say that I probably, if there is a long setup generated then, so meaning we are trading above this yellow line here, and we are breaking above the high of the defined range between 230 and 315, I'd probably reduce my position size. So I'm not really keen to trade this very aggressively today. But to me, yesterday's price action, the spike in yields here makes the impression as if there's potential for another leg lower and an acceleration of this move here. And this current move, which is mostly driven by the price action in Euro equity markets or European equity markets, is something I don't really buy. So I wouldn't be surprised if the DAX will see some pressure here against the level around 12,400 points. By the way, that's also something which I mentioned already in the morning. So just let me share with you a line in my trading chat box. It's a chat box in German. So most of you guys probably won't get any big value out of this, but I just want to share with you that I'm not just saying 12,400 points is relevant, but that I mentioned this already in the morning here. Also, 1 second, where is it? So quite active, as you can see here. There we go. So I started out quite bearish for the day. So you can see here open range between 12,350 and 12,331. And there is FOTA. This means advantage is short. And I consider the mode to be neutral above 280, 300. That was, by the way, exactly the region I mentioned earlier. And then I said, we've seen the breakout of the open range on the upside. That's something you can see here. So this is the open range between 350. This is the low. I'm sorry, not 350, 337, in fact. It's not really right. This is a small mistake at my end here. So, and 381. So obviously I'm working with this open range scenario here, not just for the DAX, but also not just for the S&P, but also for the DAX, for example. And then you see these small breakouts here on the upside. And I continue with saying that we are trading below the 50 exponential moving average on a 5 minutes time frame. And so it's intraday short. It's an intraday short mode in which we are, and that a potential short trigger can be found around 12,400 points. This hasn't changed, in fact, even though we haven't triggered at 12,400 points here, but traded only around 390 here in this candle here, and then from there we went lower and attacked this region around 280, 300 around. And reversed sharply from there. Right now, trading around 12,400 points now again, having obviously trouble to make it significantly above that level. Sure, we have to wait till the US markets open. And if they come in bullish, I mean, I'm skeptical that they will, but nevertheless, there's still the chance. Then, obviously, the market, in this case, the DAX, will follow the price action in the US equity markets. And there's a high chance that will make it significantly above 12,400 points. But right now, you can still see my skepticism. It started already in the morning. Unfortunately, we weren't triggered. There was this attack at 280, 300, and I think we are not yet done. And if we don't make it to these levels today, I doubt that we'll break out of this range here today, and then we have a great chance to see such an attack then tomorrow. Let's just wait and see. But again, this is most interesting for me because of the DAX being the main asset here traded in Germany, respectively, in Europe in general. I know that the DAX is one of the most traded assets here at JFD brokers, for example, and not just in Germany, but also in other European countries. And probably some of the UK guys listening to me right now will say, yes, FTSE, respectively UK 100, surely an asset to watch, even though the DAX is more active because of the volatility and the spikes we get to see. And again, let's just wait and see what the US markets will deliver. I'm definitely not buying this current intraday price action against the region around 280, 300. I still consider chances to be given that there will be another attack if US markets come in weaker, and probably attack again the region around 24,000 and 500, 550 points here. So in fact, we're making it, we are currently, in fact, it's already intraday, which shows that volatility stays high. So we're traded as low as around 24,600 points and currently are trading around 24,900. This is 300 points. It's overnight trading, which is already quite huge. If you look at this range here. And with this volatility already overnight without big volume, you can clearly see that there's easily the chance, once bigger volume hits then at 2:30 p.m. GMT, that there's a good chance that probably we'll see another push lower, especially if this fear from yesterday continues. By the way, we will have a deeper look at what happened yesterday and why this is significant. In fact, even though it's very, very similar, what I'll present to you here, it's very, very similar to what I presented to you last week around the inflation data. So what happened here yesterday? Why is that? That the S&P 500 here on a 50-minute time frame has seen some serious pressure then into the close of the trading day, and not gaining any further momentum here in the S&P then. Why is that? What happened here? I think the main reason for that really came with the bad minutes. And even though it doesn't seem that obvious, or it's difficult to probably see this, or this more restrictive approach from the Fed, still the market is clearly giving away an information which shows we are hearing more hawkishness here in the statement, and it's not just 3 rate hikes but probably also 4. That perfectly explains also the price action in the currency markets. That perfectly explains why and what happened here in the euro, for example, which aggressively pushed lower, even though now you can see that we're aggressively bought back here. By the way, I just have to look up what currently triggers this action here. Let's just have a look first of all at the JFD Research website. I'll open it here for you. So you can get access to this website via jfdbrokers.com, and then just go to research and education. And there you have the chance to see all those pieces here. We are writing on a daily basis. It's, for example, here, Darius writing right now. Pambos is delivering most of the time fundamental pieces, but also strategic report. You can sign up here for, and then you get institutional grade research for free once a week, and to get an overview of all markets, technical levels to watch, fundamental events you should take care of. All this here via the JFD Research website. And then what we do now is we scroll a little and we'll have a look here at the economic calendar Thursday. And now let's have a look here which data potentially caused some volatility. And to be honest, I don't see anything at all. I don't see any news events today. It would have been a surprise, to be honest. Let me just check Twitter here. What's happening here? Not really. So what's definitely worth noting is probably here. It's the ECB policy meeting. It's the ECB minutes, if you want. And let's just see when this move started. No, not one bit. So it's here. This is probably, that's a 50-minute time frame. So probably here you've seen some volatility at 12:30 p.m. GMT, but all in all, this move higher here is most likely initiated thanks to employment situation. Difficult, very difficult, because it's a 1 week event, and so there's not such a huge difference, and it's such a big surprise potential, let's call it. Let's just see. Sorry, not seeing anything here. Most likely purely technical driven, algo driven. I don't know. It's really difficult to say what's the reason here for this push higher now. All we can say right now is that the US dollar is obviously giving back all the gains here from yesterday. It has seen, especially against the uh, um, against the euro, but also against GBP. Yeah, we can see GBP also gaining some momentum here. I consider, to be honest, I consider GBP still to be a potential outperformer against the euro, by the way, also against the US dollar. Main reason for that is because of the Bank of England to be, since yesterday, to be expected the second most restrictive one till mid 2018. It's mainly due to this chart here. 1 second. Okay. 1 sec. Let me just show you here one chart. It's a chart which was published yesterday from John Kicklighter. Very good analyst, I think, and a good follow, strong follow, if you ask me on Twitter here. And he was showing the probability of a 25 basis point rate hike here by mid 2018. As you can see here, clearly the Fed is expected to hike rates. By the way, we will have a deeper look at why this is not necessarily bullish for the US dollar at all. And also why it is potentially bearish for equities. But that's something we'll look at a little later on. First of all, let's have a look here at GBP, what I just said. Why I've considered pound sterling to be potentially an outperformer against the euro especially has to do with the fact that currently market participants here are expecting the Bank of England to hike rates at least once within the next months till mid 2018. And chances are right now higher than it was around 2-3 weeks ago, when there was a huge weight here for such a rate hike for the Bank of Canada. In fact, latest data here around the retail sales, I think those data disappointed. By the way, 1 second, please. I'll just return in a few seconds. 1 second, please. So here I am back again. I'm sorry, I just had to talk to someone here out of the office. So yeah, retail sales. I'm disappointed. Around the Canadian dollar. Just 1 second. Let's have a look here. Quick check how they came in. Yeah, minus 0.8, minus 1.8%. That potentially right now had a negative impact on the Canadian dollar. Wouldn't be surprised. Let's have a look here at dollar Canadian dollar. Probably, yeah, obviously US dollar can continue its run here higher. Let's have a look at the 50-minute chart. You can see it here. Yeah, so that was around half an hour ago. I haven't checked those numbers, by the way, before. So yeah, it's 40 pips lower. It's or respectively, no, that's not right. We started here. It's dollar Canadian dollar. We are not looking at the future. So sometimes it's difficult because if you once traded the Canadian dollar future, you have to make sure that you reverse this. So if CAD/USD moves higher, future moves higher, that means usually that dollar CAD's moving lower, the other way around. So yeah, sometimes it's I have to remind myself that it's dollar CAD what I'm looking at here right now, which means that a push higher is naturally to be seen Canadian dollar weaker, and it's most likely that we will continue here because not just of the US dollar strength, but also because the Canadian dollar has seen right from the start of the year, end of last year, but also start of the year, has seen some gains here, which were most likely due to the fact that the Canadian Central Bank, the Bank of Canada here, was expected to hike rates quite aggressively, probably also due to some really good data coming in from the Canadian economy. And as you can see here now, retail says probably, yeah, not just probably, but disappointed, and that's most likely to cause Canadian dollar to lose here. But let's come back to the pound sterling here. So pound sterling, I think, has some good potential if the US dollar can continue its current run here to probably outperform. So this is the US dollar. As you can see here, we are currently not talking about a strong US dollar at all, but we are most likely talking about a US dollar which is only see a corrective move. Probably it can extend it above 90.50, but then against 91, 91.30 here, the upper channel trend line. I think, or these lows from 2017, I think this is a potential short trigger against which you can then consider short engagements again in the US dollar again. And probably GBP has some good outperformance potential here against the US dollar, but also probably against the euro. So euro GBP, let's have a look here at this one. I think it was a close one. It was really close, since if we make it above 89.30 here on the upside, then this idea around this descending triangle is definitely not valid anymore, even though right now I still see a chance of a quite significant attack ahead of us against 87, 87.50 to happen rather sooner than later. So with this in mind here, I have to say that this formation, even though it's not very nice anymore, even though everything below 89.30 should be considered neutral, but with a clear bearish stance. And I wouldn't be surprised to see an attack at 87, 87.50 on the downside in Euro GBP in the next weeks to months, with then potential down towards 83, 83.30. But we are jumping a little, in fact. So what we have to focus on, should focus on, based on the fact that we are looking at the US market opening right now, it's probably the reaction of equity markets, also the currency markets to the Fed minutes yesterday. And this reaction suggests that the market is right now more and more fearful that we are probably to start to see the US seeing some kind of stagflationary tendency, let's say. What do I mean by that? Well, I mean by that the fiscal stimulus, which was brought up by the tax reform of the Trump administration, is resulting in inflationary pressure building, while on the other hand, the momentum in the U.S. economy is not given anymore. So we are not capable of overcoming this inflationary pressure building. We're not overcoming it with strong economic growth, but we're probably more likely to enter recession rather sooner or later. And with this in mind, such a push here in the equity markets definitely makes sense. But I really don't want only to reduce my research here on this potential for economic growth diminishing here in the near term, and on the other hand, seeing some inflationary pressure building. But I want to emphasize the risk of a potential and very aggressive deleveraging taking place. That was most likely also one of the main reasons why we've seen this crash at the beginning of the month, and volatility spiking higher. It was a potential. We haven't seen an update yet here, but it was a potential first deleveraging taking place. And this is a very interesting chart, in fact, which could rather sooner or later become or play a crucial role here. So it's showing the margin debt and the S&P 500. And as you can see here, we've seen after the Fed hiking rates, so margin debt rose dramatically from 2006 up to 2007, 2008 here, rose aggressively higher, and markets were hugely leveraged on record, in fact, here. And when the Fed back then hiked rates, in fact, they stopped hiking rates a little before that, but building margin debt here. So one sec, let's have a look here at the indicators. It's also here. We can have a look at this tradingeconomics.com, by the way, great website with lots of economic indicators completely for free. Let's have a look here at the United States, and there, let's have a look at the interest rate. And now let's go back to 10 years. Is this enough? Not really, max here. So you can see that the Fed, not sure about the year when they started to hike rates back then, I think 2005, I think. They hiked rates up to 5%. By the way, also a number which is was mentioned here from someone. Let me just show you a retweet of mine. I retweeted yesterday in the morning. That was before the Fed minutes in the evening. I want to share with you. Or was it already on Monday? Not sure. 20th of February, Tuesday. Probably even before that. Not. One sec. Let me just see. Oh, that's interesting. Okay, so probably I haven't seen it yet. Well, one second. So it's also here. The 20th. Yes, history shows that stocks and yields tend to move together, respectively higher, until the 10-year hits about 5%. Still a long way to go till then. This is all in all a statement which is very interesting, because it usually means if yields rise, usually stocks should go up. If you look at the past, the thing is, we haven't seen such a leveraged market environment before. And again, let's come back here to this chart. As you can see here, even though we are obviously going quite aggressively back, you can see here 1980, that was Volcker back then, fighting inflation back then, which also resulted in the crash in gold. But let's have a look here at this development shortly before the financial crisis hit the markets. Then that was margin debt was aggressively built here, and the markets were hugely leveraged. And rather soon later, you hit a level where this debt can't be paid back anymore. And this is usually the moment when the market will crash then. So I'm not saying we are about to see a crash. Nevertheless, if you see such a huge margin debt being built over time here, based on all this ultra loose monetary policy from the central banks around the globe, well, the thing is that rising yields usually have negative consequences for equity markets. And with this in mind, it perfectly makes sense why a more restrictive interpretation of the Fed minutes yesterday resulted in a pullback, or probably already resulted in a pullback last week around the CPI numbers, which came in above expectation, while retail sales, for example, dropped. Also, why at the beginning of the month the market saw some more aggressive pullback here when yields started building some serious momentum. Let's have a look here at Bloomberg and 10-year yields for US Treasury notes. And here you can see that right now we are about to hit 3%, most likely in the upcoming days. And there you can see it already here. Beginning of the year, we started to build some momentum, and then we pushed to higher levels than we've seen after the election of Donald Trump. And here, there was rather soon later, it was clear that there would be a catalyst, or that yields here in general would be a catalyst which would trigger then potential pullback in equities, potentially resulting in higher volatility also. Usually there's a strong connection between volatility and yields, especially in the fixed market, since higher volatility, higher yields usually mean that carry trades, for example, are more attractive to build, respectively. Once nervousness hits the markets, that this should usually result in a more aggressive unwind in carry trades. So this should usually result in higher volatility. So naturally, higher rates mean higher volatility. And higher volatility then comes down when looking at the markets right now, especially if high frequency trading, for example, results in thinning out liquidity, since those algorithms on HFTs usually tend to switch themselves off once volatility hits a certain threshold. If the market is then aggressively short volatility, well, you get to see some kind of domino effect. And all these components, if you bring them together, perfectly explain, I think, why the current market environment, especially after this more restrictive interpretation of the Fed statement yesterday, is more likely to trigger bearish price action than it is to trigger bullish price action. That's what I wanted to just bring up here, to make sure that you understand why I'm very skeptical about today's price action on the upside, and why I tend to be bearish in my overall interpretation, meaning nothing more than the following. If I have a clear trading setup, which I know to be profitable. By the way, I just want to show you a chart here, which shows the performance of this setup here over the last 7 to 8 years. Something which is in fact very important, because you probably will just say, I can't believe that this works out over time, because it's very, very simple. But this is in fact usually how trading setups should be built. So very easy duplicable, and easy to test, in fact, whether the idea worked or not. So probably you will now say, hey, can't we just try to program this, and then let's run a backtest over a certain period of time, depending on the data set we are getting. Yes, sure, that's exactly what good trading setup is about. So having an idea which makes sense, then program it, test it over a quite good and long time span, and see whether it's stable or generating stable results, and then going from there, just trading the setup over and over again and capitalize on the identified advantage. Even though there might be times in which a period in which this setup probably does not work. For example, low volatility market environments, as last year, lots of fake outs here, markets not really taking on momentum and all this. Nevertheless, keep on trading it, and rather sooner or later, the tide will turn, let's say, and then the market environment fits the trading approach again. And with a serious and solid risk and money management plan, you're capable of surviving those series in which this system does not work, and then profitably or capitalize perfectly and good on those occasions when the system corresponds really well with the current market conditions. So this is in fact here. This is the equity curve which was generated for this trading approach here, this open range breakout setup, which I just want to present to you here. And you can see here also, you can play around a little with this tool with an exponential moving average 10. So no surprise, you see this number here when it comes to the 50-minute exponential moving average 10 here. And so now the thing is, you can see here where the stop is placed, obviously above, respectively below the high and low of the range. And then you just trade in direction of this identified advantage, meaning if we're trading, again, above the 50-minute exponential moving average here on a period 10, well, we're going long with breakouts on the upside, not short. Let me just give you an example. Why we are definitely not long the DAX based on the open range breakout here today. So let's assume you adopt this, and in fact, the adoption of this is that I work on a 5-minute time frame here, on a 5-minute time frame with the exponential moving average 50 here, and then I have the open range between 7 a.m. GMT and 8:05 a.m. GMT every day. So, and then I say, okay, I trade the break out of the open range on the upside if we trade above this blue line, and I trade it on the downside if we are below that blue line. So now look what happened here in the morning. This is the open range which was defined. We didn't break it on the downside, but instead broke it on the upside. Did I trade the break on the upside? No. Why? Obviously, we're trading below this blue line, the 50 exponential moving average on a 5-minute time frame. So I'm not trading it long, but instead I would trade it on the downside. Even though one could now say, if we broke out of the open range before, well, we are not trading the DAX based on this open range setup at all, for example. That could be a trading filter. Depending on your trading rules, you have to test everything. Sure, it has to fit your personality. But this is a perfect example of when we don't trade here in this case. So in fact, we are not trading because of the break on the upside, which is a clear generated signal, even though we're trading below our trending filter, which means we usually only trade the short side. And that's one of the reasons why we don't trade at all today. So now we can adopt this open range setup here to the S&P, which means, for example, that currently we are trading above this yellow line, which means we have to wait another 30 to 35 minutes here until we have our open range defined, and then we can decide whether go long or short. But, and this is the thing, currently we have to trade the long side. So because our setup says trade in direction of the identified advantage. If we're trading above the 15 exponential moving average and the open range is defined and we're breaking it on the upside, we trade the long side. So, but nevertheless, with all said, and volatility rising, and obviously market participants getting nervous about higher yields, which can perfectly be seen here in yesterday's price action, I nevertheless would today argue that it makes definitely sense to intervene from a discretionary standpoint and say, let's probably scale back here and reduce the position size. So, or let's put it that way. If you usually say, well, I'm risking 1% of my equity per trade, it probably makes sense if we get to see such a break on the upside today and have to trade the long side, it probably makes sense to say, okay, I only trade 0.5%, for example, with this approach. If we trade, or if we break this open range, which still has to be defined here, but if we break it then on the downside, well, then I probably go with this 1%. Not sure whether we should definitely go for a more aggressive approach here, probably risking 1.2, 1.5%, but I think 1% is reasonable then in this case, and trade the setup as usual. With the position size you have done your test with. So that approach used here, make sure that you're listening to what the market is telling you. Based on the price action from yesterday, it's telling you, well, be careful. Be careful here, even though currently it looks as if everything's fine, right? We are opening here at 2,711.6. And the market right now is trading 10 points higher within the first 10 minutes of trading. So this is not necessarily a sign of weakness, even though, again, we've seen something similar yesterday also. And the market then turned aggressively lower. And this is definitely something to worry about and to be to make sure that we definitely consider this price action from yesterday to be something to be skeptical about, let's say. So yeah, that's it. In fact, on this setup, let me just probably show you an example of how this worked out yesterday, if it worked out at all. In fact, yesterday the trade would have triggered or would have been a losing trade, even though it initially looked really nice. So let's lose this line here, make it a purple one, and probably here. So what can we see here? Well, obviously, this is the high, the candle at 3:45 German time, so 2:45 GMT. Here's the high. Obviously, this is the candle at 4 p.m. German time, so 3 p.m. GMT. With the close of this, since this is a 50-minute time frame, this is obviously the high of the open range. We have to look for the open range between 2:30 and 3:15. Okay, and then we are duplicating this here, this line, and just have a look at this candle, which has a low at 716. So 716 is in fact right here. Yes, perfect. It's here. And so, well, what do we know so far is this is the open range. Okay. What will we do? Well, trade the break out of this open range once the high is triggered and we're trading above this yellow line. This is happening right here. So now you can see the market did not really take on any momentum, but on the other hand, did not aggressively and sharply pull back either. So all in all, you can see that we are triggered on the long side. We don't move our stop, which is placed here below this low of this range. And then you can see that the market here around 7 p.m. GMT takes on serious momentum on the upside. It's pushing higher. So now the question is, do you move the stop or not? Depending on how you usually manage your trades. Important to say that, because now the thing is, after we see what happens here, well, obviously it makes more sense to trail the stop probably here to this, let's say, consolidation low, and place it into 726, reducing massively the potential loss we have seen then a little later on when the market here at around 8 p.m. GMT dropped quite aggressively and triggered our stop, which is still placed here. In fact, we are trading a so-called make or break approach. Usually, or what this chart shows is a make or break, which means you're entering the trade based on those parameters here. You place the stop above, respectively below the range you've identified, and then you close out the position at, in our case, 8:50 p.m. GMT automatically. So you take out the position wherever it might trade, if you're not getting stopped out before. In this case, yesterday, we got stopped out because the market obviously pushed lower. Then again, you have the chance to intervene discretionary. And the question you might wonder here and ask yourself is, does this make sense to intervene here from a discretionary standpoint? Purely and 100% automated trading strategies, respectively traders who run those strategies, they will say, I definitely don't ever, because intervention in a system, something which is most of the time, and especially when a beginner is doing that, something which is based on so-called cognitive biases. And cognitive biases usually, especially if these are the negative cognitive biases we know, like loss aversion, for example, this is definitely something which has a negative expected value over time. So an intervention from this perspective is definitely something I don't consider ever. I'm a little different here, because what I usually do is, when I run an automated strategy, I usually use it as a signal provider for my trading. And then I start to optimize my expected value. What do I mean by that? Well, what I do is I not just only look at one trade, but a series of trades. I have a result. I run the strategy, for example, fully automated in a demo account. And then I have my live account running, where I use the signal, signals which are provided to me. And then I manage the stop manually. For example, if I do this, and let's assume I had the read on the market for whatever reason, to trail my stop here to this level, then I would have gotten a better result than the strategy would have gotten. What do I mean by that? Well, let me just do the following here. Let's open editor. And now let's see. The open range here is 716.5 and 731.75. So this is the open range. 715.5, 731. Say 5. So that means that the open range is 16 points. Now, let's assume that this 16 points is connected to a euro value or US dollar value, pound sterling value, whatever. Meaning, for example, you're saying, hey, I'm trading a 10,000 euro account. This is my account size. And then I'm risking 1% of that. 1% risk per trade. That means that, let's just do it here. It's 100 euros your risk per trade. So now we divide those 100 euros through those 16 points and get 100 16, 6.25 contracts. Why is it possible to trade this? Well, thanks to the so-called micronization. So, for example, JFD is offering micro lots, which makes it possible to trade as low as 0.1 S&P here in this case. Now, you're trading 6.25 contracts. Now, what we can say, even though this, in fact, doesn't really matter, what I just did here, just to show you how to calculate position size, but I put this here in brackets. So what I want to refer to is the following. When you trade this and you have a solid back test, which you ran here, you have, for example, is you have a number for the win rate. You have an average profit, you have an average loss. So this, in fact, is something which is bringing you in a great position to calculate the so-called expected value. Meaning, we now multiply those 47% with the average gain, in fact, 1.31. So what I do is here, to make things easier, I already divide the average profit by the average loss, which is 1.08 through A2. This is 1.32 to 1. And then you subtract 53 multiplied with 1. As you can see, that's way easier to calculate. Now, I only have to calculate the first bracket here, which is 47 multiplied with 1.32 is 62. I subtract 53, which means I'm getting on average 0.09 euros per euro by risk. So what do I mean by that? Well, this is a so-called expected value. It's not that I'm risking, let's say, 1 euro here to gain 9 cents, but it's the expected value on every trade I make, even if it's a winner or a loser, doesn't matter. And with this in mind now, obviously, what do I try in my trading? Well, obviously, I try to get a bigger number here, which is here 0.09. So what we'll do now, by the way, let me just delete all this here to make things easier. Okay, so let's just bring this down to this number here. So if my expected value is 0.09, obviously what I should aim on, if I know that my strategy I'm running here is profitable already, well, what I should try obviously is to grow this number. Let's say to 10, let's say to 11, 12, probably double it, whatever. So what I try now is the following. I have a basic strategy, which obviously is profitable with something you can see here. We've just calculated it. It's a profitable trading approach. And now my target is over a certain period of time, let's say 100 trades, 200 trades, whatever number you call it. I try to make sure that I try to increase my expected value. How can I achieve this? Well, obviously by, for example, getting bigger gains and reducing potential losing trades. Meaning, coming back to the example from yesterday, well, if we see that this is a region where I place my stop, and here is a level below which I probably should think about taking out my position, and I really do this, so taking out the loss at 2,726.5, well, obviously, I'm saving 11 points here. And instead of losing 16, I'm only losing 5. Okay? By losing 5 instead of 16, you obviously reduced your potential loss by over 60%. Is this a good loss? 100% yes. It's a very, very good loss. So if someone asks me, hey, what was your trading day yesterday? I said, yeah, I lost. It was a great day. You would probably look at me and say, what exactly do you mean? You just lost money and you still think it was a good day? Oh, yes, it was a perfect day. Why? Well, because I know that I'm a winner. I know that I'm a winner. What do I mean by that? Well, being a winner in trading means you're trading with a positive expected value. You're making money every trade you make, even though it's a losing trade. And you're making even more money if you're capable of optimizing this expected value. That has nothing to do with trying to justify losing trades or something like that. No, it's just the case. It's from a mathematical standpoint, you're doing a great job if you can optimize your expected value. 1 second, please. Okay, I have to. So, why do I do this? Well, what you get to see here is the result of the strategy with any kind of intervention at your end. When intervening in a strategy and really thinking about probably going more aggressive with your stop, reducing your position size because of a certain opinion you might have, or a picture which the market is drawing here, well, what you're aiming on is very simple. You try to smoothen the equity curve. So here in this case, obviously it's already profitable and you don't need to intervene at all. It's just like trade the strategy. Just click the button, there we go. That's it. But, and this is the thing, what you can see here is obviously that, for example, the max drawdown was 17% within this tested time frame. And now the thing is, my personal trading and the money I'm managing for my clients, for example, I try to get this number below 10. And I really try to make sure to have a very smooth and very stable equity curve here, which I can generate. And this is my job as a money manager / as a trader. So if I'm not managing clients' money as I do, but trading my own account, I trade my own account as if I was my own investor. And this is exactly what professional trading then comes down to. It's in fact what professional trading is about. The great thing about this is, and by the way, I haven't checked the chat box so far. Let me just have a look here. Okay, so it's many times it happened to me. I mean, I'm doing this for quite a while now, so over 10 years. Holding webinars and giving people some insights in my trading strategies and how I look at the markets and everything. And over the years, there are many questions. And it happens so many times that people just come and say, okay, what do you think? EURUSD going up or down? What do you think? DAX going up or down? What do you think? S&P going up or going down? So in fact, I have an opinion. And sure, I discussed my opinion with my colleagues. Have a look here. Great colleagues on JFD Research. I highly recommend checking out, again, the research website here from JFD Research. Go over to jfdbrokers.com. There is, by the way, just let me guide you through this. jfdbrokers.com. And then check out the research section here. Research and Ausbildung is German. Research and Education. Just click here and you're there. This is exactly the same page as you can see here. So now these are my colleagues from Czech, for example. It's Azen, It's me. Yes, this is Darius. He's running daily streams, 10 minutes around the US market opening, also in the morning already at 7 a.m. GMT. So if you need anything to prepare for the price action in the markets, I highly recommend checking out the YouTube channel every morning, 7 a.m. GMT, listening to what Darius has to deliver here. Pambo's great fundamental guy, for example. And I discussed the markets. Let's come back to our initial discussion. I discussed the markets and my opinion with them. Are we going up? Are we going down, for example? And we both, for example, Darius and I had just had a discussion today. We both agree, by the way, obviously you can see that the S&P can hold these gains, which is not a positive sign at all. Imagine we went down up 10 points and now moving down these 10 points again. Let's just have a look at the DAX. Yeah, obviously the DAX doesn't like this at all, and it's coming lower again. Very choppy price action, in fact. So we're talking about potential for a trend if we make it below 280, 300. But we had a discussion somewhere here in the middle of nowhere, and we were both discussing, hey, what do you think? Market going up or going down? And sure, we have an opinion. But when it comes to profitability in trading, when it comes to professional trading, no one really cares if the market goes up or down. The thing is, if you are long based on a predefined setup like this, again, we have to wait another like 15 minutes. So we won't formulate the open range today, even though it seems as if the high currently can be found somewhere around 721 in the S&P. But we still have to wait for the low. We define the open range, and the market will tell where it breaks out, and our filter will tell whether we are entering or not. If we are trading below the exponential moving average 10 on a 50-minute time frame and breaking on the downside, we are short. And we can't say whether the market will keep on falling or not. The market will just deliver the outcome over the next minutes and hours. We just don't know whether we will make a profit on this trade or not. But we know that the definition of our setup brings us in a position to run a test over a quite long period of time to find out whether it has been profitable in the past. And it was. And I think, again, this is a very, very simple setup, and it's generating a very, very stable and very attractive equity curve here. Well, if this has been the case in the past, you know the quote, the trend is your friend. The same is true for equity curves. We expect the strategy to continue to work in the future. And that's why we trade with this strategy, even though that doesn't necessarily mean that the outcome here over the next years will be the same as it was here over the last 7-8 years. Time will tell, even though I can say that we're only working here till November 2010. What I can say is that this approach itself was not really invented, but it was brought to public by a guy called Toby Crable. Toby Crable is a hedge fund manager today, by the way. And some of you might have heard about a classic, even though it's not available anymore. Let's just have a look here at Amazon. It's short-term trading patterns. Let's just see. Toby Crable. So here. Not so bad, right? 3,400. I think it's for those who are really, really interested in it. So also here, that was in fact when he where he published his thoughts on this, and then he wrote it down in a book that was in a trading magazine in the 1980s, I think. So this strategy is there already for something like 30-40 years, and in fact, the idea behind this hasn't really changed. And now the thing is that most likely this trend will continue for whatever reason. It will just most likely continue. And now the thing is, really, once again, we don't care whether the market will go up or down, whether the trend, whether the trade will be a winner or a loser, because we know we have an edge and we try to capitalize on this edge. All we can do once we plan to intervene here from a discretionary perspective, all we can do is we can try to increase our expected value here. So try to bring up this number to, like, say, like 11 cents or something like that. What does it mean? Well, let me just give you a quick example at the end here of this webinar now. So 9 cents, let's say we have a 100,000 euro account, okay? So let's assume it's a million. Let's assume it's a million. Why? Well, it's an account you trade for clients. Okay, it's a money manager looking at those numbers. He's managing 1 million. Okay, now per trade, he's risking 1% or 10,000 euros. By the way, it's Germany, by the way, we work with dots, not with commas here in this case. So he's risking 10,000 euros, meaning with an expected value of 9 cents, his trader is expecting to make 900 euros on every trade on average. What do we mean by that? Well, we just multiply the expected value here, 9 cents, with 10,000. And this is the expected value. So, and if we can stabilize those numbers, well, great, then we can expect to make 900 euros on average. Now, let's just think we're making 200 trades a year. 200 trades means we're making 200 times multiplied 900, which means 180,000, which means 18% per annum. Great, right? Now, what do we try to achieve is increase the expected value. What will, let's say we can push this number up to 11. Instead of 9, we'll now have an expected value of 11 because of our skill to letting winning trades run, cutting losing trades short, as we did here, for example, by taking out the trade instead of at 7.15.5 at 7.26.5. So 11 points better, whatever. So now we can stabilize this. Now let's assume we're making 11 instead of 9 cents per trade. That means we are expecting, trader expects to make 1,100 euros per trade on every trade on average. So 200 trades again. We're multiplying those 200 with 1,100, getting 22,000. 200 multiplied with 1,100, 220,000, 220,000. And voila, we are now making 22% per year. See? And this is why it's so important to focus on the expected value of your trading. And now you can see, if you're running these numbers, all you do is you just have your setup and you really don't care whether the market will go up or down, the trade will be a winner or a loser. Well, if you just keep on trading it over and over and over again, there will be times when you will outperform the system. Outperform the system, not. It's outperform the market. We call it variance. So there's a time in which you just will naturally see the equity grow based on great market conditions. Just imagine here, 2014, 13, 14. Look at this. It's nearly parabolic. You traded the system and it just shot through the roof. Okay, there will time when, well, the system was doing okay. As here, for example, low volatility market environment, horrible market conditions. That's natural. It's like having or selling ice cream. Well, once it's summer, everyone can get rich selling ice cream. Once it's winter, well, things are getting a little difficult and complicated. And this is exactly what you should focus on. So in fact, when you develop a belief like this, your trading will become not easier necessarily, but I'd call it boring. Boring, which is also, and all the time, in my opinion, a very positive sign, because boring means that you're repeating a certain pattern over and over again, and you're not really excited to see the market moving up or down, but just completely neutral and look at the numbers and try to optimize those numbers. And in the long run, you will come out ahead. Sounds somehow weird. And again, it's not sad that you will come out ahead, because systems have tendency to perform well under certain market conditions, and sometimes they just break down and don't work anymore. Nevertheless, chances are highly given that this trend will naturally continue, and the strategy will keep on working. And yeah, so that's it. I hope you enjoyed it, and if you have any questions, please feel free to shoot me an email. I just give here again my email address. If you have any questions. By the way, also something I can tell you, I can easily send you over the strategy here around the DAX. So I not just mentioned here the definition for the open range breakout setup for the S&P, but also mentioned it for the DAX. That's something I trade, for example. So just shoot me an email. Very interesting stuff to read, in fact. And yeah, so that's it from my end. I hope you enjoyed this webinar. Next week, 10:30 a.m. GMT. Again, it will be the first day of the month before the first Friday of the month. Usually, I'm not sure whether next week there will be the NFPs on Friday. But if the NFPs are held or are released on the 2nd of March, then next week we'll have a look at the fundamentals before this rate hike, this employment situation, which will be published there. Okay, that's it from my end. Have a nice day, nice afternoon, happy trading. Watch your stops. Take care. Talk to you again next week on Thursday, or already tomorrow in the JFD live stream on the YouTube channel. That's it from my end. See you and goodbye.